The number appeared on page 14, halfway down a valuation packet nobody outside the room was supposed to see. $1.8 billion. You were sitting beneath fluorescent lights in a borrowed conference room, eating pretzels from a vending machine bag because the meeting had run through lunch. On the table sat a scuffed brass key attached to a faded blue fabric loop, the key to the first office you had bought 20 years earlier. Back then, you had wired in $120,000 of your own savings, borrowed $840,000 from a bank, and signed a $240,000 seller note for a company with 14 employees and $260,000 in annual adjusted operating earnings. Now, the holding company produced approximately $330 million in adjusted EBITDA. At 13 times that figure, the illustrative enterprise value was $4.29 billion. Subtract $1.29 billion in net debt, and the estimated equity value was $3 billion. Your fully diluted ownership was 60%. On paper, before taxes, and without a sale, your stake was worth approximately $1.8 billion. Your phone buzzed again. The board was waiting for your answer about a set of suspicious inspection records, an answer that could cost at least $42 million, damage the valuation, and force the company to admit that part of its operating system had failed. You closed the packet and turned the old key in your hand. The question was no longer how you had become the first billionaire in your family. It was whether the system that made you one could survive the first decision that required you to make the number smaller. 20 years earlier, nobody would have described you as trapped. You earned $108,000 a year managing service operations for a commercial fire and life safety company. Your estimated take-home pay was about $78,000. Your household spent approximately $54,000 a year. Student loan and auto debt payments consumed another $9,600. That left about $14,400 in annual savings when nothing expensive broke. You had accumulated $154,000 in cash and $96,000 in retirement accounts. After subtracting $22,000 in student debt and $11,000 on the car, your net worth was approximately $217,000. You were doing better than anyone in your family had done at your age. But nearly all your future income still depended on the same thing, showing up and remaining useful to an employer. Your father had spent 34 years machining parts on the night shift. Your mother had driven between home health clients because missing one visit meant losing part of her pay. They had taught you that reliable work created safety. You had started wondering whether work alone could ever create freedom. The opportunity arrived through Alan Price, the 61-year-old owner of a small inspection and maintenance company. His business generated $1.65 million in annual revenue and approximately $260,000 in adjusted EBITDA. 14 employees handled recurring inspections, testing, maintenance, and repair work for commercial properties. Alan wanted $1.2 million. You did not have $1.2 million. What you had was 8 years of operating experience, $120,000 you were willing to risk, and a detailed plan showing how the company could improve without firing the people who had built it. Alan cared about the price, but he also cared about what happened after closing. Some prospective buyers treated his technicians like expense lines. You knew their certification levels, route problems, customer histories, and which jobs looked profitable until a truck spent 3 hours crossing the city. Elena studied the proposed deal at the kitchen table. How much cash would we have left? $34,000. And the retirement money? Untouched. If the company misses a payment, the bank still gets paid. She looked at the personal guarantee and then at you. So this is not a 12% investment. No. This is one company, one market, and almost all our liquid savings. Yes. The answer did not make the risk smaller. It made the decision honest. Alan ultimately chose the buyer he believed would protect the operation, even though another structure might have made his exit easier. He was not handing you freedom. He was handing you responsibility, and enough financing to discover whether you knew the difference. The purchase price was $1.2 million. Your cash contribution covered $120,000. The bank financed $840,000. Alan agreed to carry the remaining $240,000 as a seller note. The seller note reduced the amount of cash you needed at closing, but it was not free money. It created another fixed obligation, and Alan was accepting the risk that you might fail before paying him in full. When the transaction closed, you had $34,000 in personal cash left. Your retirement account stayed untouched. Alan placed the brass office key in your hand and said, "The door sticks when it rains." That was the entire ceremony. The next morning, you arrived before sunrise expecting to feel like an owner. Instead, you found 3 technicians waiting for assignments, 2 inspection reports that had not been invoiced, a truck scheduled on opposite sides of the city, and a customer asking why nobody had returned a call from the previous Thursday. Ownership did not feel passive. It felt like every unresolved problem had learned your name. The company had recurring inspection contracts, but recurring did not mean guaranteed. Customers could leave. Technicians could quit. Equipment could fail. A contract could renew while the work itself produced little profit. The advantage was predictability. Many buildings required inspections on regular schedules. If the company performed reliable work, maintained customer trust, and followed up before renewal dates, part of next year's demand could be seen in advance. That gave you something most ordinary wage earners never receive, a clearer view of future cash flow. But first, you had to stop wasting it. The dispatch process depended on paper folders, memory, and whichever employee answered the phone. Technicians spent too much time driving between poorly grouped appointments. Emergency jobs interrupted higher-margin planned work. Prices had been adjusted inconsistently because Alan disliked asking long-term customers to pay more. You did not begin with layoffs. You began with the schedule. Jobs were grouped by geography. Inspection cycles were entered into one renewal system. Quotes received expiration dates. Repair recommendations were tracked instead of left inside completed reports. Service categories that consistently lost money were repriced. Marcus Reed, the field supervisor, showed you where the spreadsheet logic failed in the real world. One afternoon, you complained that a technician had completed only 4 appointments. Marcus placed the route sheet on your desk. You gave him 6 hours of windshield time. That changed the way you measured productivity. The question was no longer how many jobs a technician completed. It was how much useful work the system made possible during paid hours. Route density improved. Overtime became more deliberate. Invoices went out faster. Customers received renewal calls before competitors had a chance to call them. None of those changes sounded revolutionary. Together, they changed the cash flow. The mechanism was not simply buying a company with debt. Debt magnified the consequences of whatever happened next. If operations improved, the company could pay interest, reduce principal, and build equity. If cash flow weakened, the same monthly obligations could consume the business. Every available dollar needed an assignment. First came payroll, taxes, insurance, and essential working capital. Then the scheduled bank and seller note payments. After that came a reserve for equipment, customer losses, and unexpected repairs. Only the remaining cash could be reinvested. You resisted the temptation to call every dollar in the bank profit. You also resisted taking large distributions merely because you owned the shares. The business needed enough cash to survive the gap between performing work and collecting payment. That working capital gap became your first education in the difference between accounting earnings and spendable money. A profitable month could still create a cash shortage if customers paid slowly. A busy month could make the problem worse because payroll and materials were due before many invoices were collected. You began building weekly cash forecasts instead of relying on the bank balance. Marcus took control of field scheduling. A senior administrator owned renewals. You documented pricing rules and separated decisions that required you from decisions the team could make without permission. Gradually, you stopped trying to become the best employee in the company. You began trying to build a company that did not need its owner to answer every question. That distinction would eventually be worth far more than the first acquisition. But at the time, you needed proof that the business could survive one full cycle of payroll, debt payments, customer renewals, and operational mistakes. Because if the first company could not produce cash after paying everyone else, there would never be a second one. 24 months after the acquisition, annual revenue had increased from $1.65 million to approximately $2.05 million. Adjusted EBITDA had risen from $260,000 to about $410,000. The improvement did not come from one extraordinary contract. It came from shorter routes, faster invoicing, more consistent pricing, higher renewal discipline, and completing repair work that had previously disappeared inside inspection reports. The original acquisition debt totaled $1.08 million. After 2 years of scheduled payments, the combined balance had fallen to approximately $912,000, a reduction of about $168,000. That debt reduction mattered because it increased your equity without requiring the company to become more valuable. But the progress was still mostly trapped inside the business. You could not spend the lower loan balance. You could not buy groceries with adjusted EBITDA. And selling the company would have triggered transaction costs, taxes, and the loss of the cash-producing asset you had spent 2 years repairing. The wealth existed, but it was not liquid. The most important proof arrived on an ordinary payment date. Alan received the seller note payment exactly as promised. He called that afternoon. I saw it. That is generally how payments work. He laughed. No. I mean, I saw what you did with the place. You had not protected every old process. You had protected the reason Alan had trusted you. The employees still had jobs, the customers still received the work they purchased, and the company could now meet its obligations with more room for error. Marcus was promoted and given authority over daily field operations. At first, you still checked his decisions after he made them. Then you learned that delegation with constant reversal was only a slower form of control. You established decision limits instead. Marcus could approve staffing, scheduling, equipment purchases, and customer remedies within defined thresholds. Larger commitments still came to you. The business improved faster once employees knew which decisions actually belonged to them. That was when the possibility of a second acquisition stopped feeling reckless. You had not touched the $96,000 retirement account. The first company had produced retained earnings, reduced its debt, and built enough operating credibility to support another carefully structured purchase. You created an acquisition filter. The target needed essential or recurring demand, understandable margins, responsible local management, low customer concentration, and a price that still worked if growth slowed. You did not want businesses that required a heroic forecast. You wanted businesses that could keep ordinary promises repeatedly. By year 5, the group had grown to 6 operating locations. Dispatch, pricing, renewal tracking, and cash forecasting were becoming standardized, while local managers retained responsibility for customers and technicians. From the outside, it looked as if you had discovered a formula. Buy a durable service company. Improve its operations. Use cash flow to reduce debt. Retain enough earnings to help fund the next acquisition. Repeat. But the first company had only proved that the math could work. It had not proved that the ownership system could survive your ambition. The second acquisition was smaller than the first, but the decision felt larger. This time, you were no longer risking only your savings. The first company's employees, cash reserves, and reputation were now connected to whatever you purchased next. You used the same filter. Recurring or essential demand. Understandable margins. Limited customer concentration. Local managers who understood the work. A purchase price that still made sense if revenue stopped growing. You also added one rule. No deal could depend on you becoming the permanent operator. That rule was easy to write and difficult to obey. By year 5, the group had 6 operating locations. Each company retained its local relationships, but dispatch, pricing discipline, renewal tracking, financial reporting, and cash forecasting followed common standards. The model was becoming repeatable. Cash generated by the operating companies paid down existing debt. Retained earnings helped fund the next acquisition. Banks supplied senior financing when the cash flow supported it. Some sellers accepted notes because they wanted a transition instead of an immediate exit. None of it eliminated risk. Seller financing created obligations. Acquisition debt amplified operating mistakes. Retained earnings belonged to the business only after payroll, taxes, working capital, reserves, and scheduled payments had been covered. You rejected deals whose numbers worked only after aggressive cost cuts or perfect growth assumptions. The discipline slowed you down. It also kept several bad businesses out of the group. By year 9, the holding company controlled 19 regional service businesses. Recurring inspection agreements created a visible base of future demand, although no contract was guaranteed to renew. Local managers handled customers and technicians. A central team managed insurance, financial reporting, capital allocation, and acquisition support. You remained almost invisible outside the industry. There were no magazine profiles, motivational speeches, or social media posts explaining how to become wealthy. Most customers knew the name of the local operating company, not the holding company behind it. That privacy helped you focus. It did not protect you from scale. Every acquisition created more exceptions. A manager wanted a larger equipment budget. A lender wanted an additional report. A regional president wanted to change compensation. A seller insisted that only you could resolve a transition dispute. Decisions you had delegated began returning to your inbox because people believed the founder's answer carried more authority. By year 11, the group owned 28 businesses producing approximately $210 million in annual revenue and $35 million in adjusted EBITDA. The cash flow was substantial. So were the limits. Buying larger companies required more capital than retained earnings and ordinary bank financing could comfortably provide. You could continue growing slowly, borrow more aggressively, or bring in an outside investor. You chose a minority recapitalization. The investor supplied growth capital and purchased a limited portion of existing ownership. You received personal liquidity for the first time, while still retaining control. But the transaction changed the company. There was now a formal board. Reporting deadlines became stricter. Acquisition proposals required investment memoranda. Debt covenants mattered across the entire platform, not merely at one operating company. Over time, additional minority capital and management equity reduced your fully diluted ownership to 60%. You had converted part of an illiquid asset into personal cash. You expected that liquidity to make your life feel less fragile. Instead, the company accelerated. More capital produced more acquisitions. More acquisitions produced more people, lenders, reports, approvals, and exceptions. You were no longer worried about whether one broken truck could disrupt payroll. You were worried about whether one weak operating company could damage a financing agreement supporting dozens of healthy ones. The personal risk had changed shape. It had not disappeared. By year 15, the holding company controlled 63 businesses generating approximately $790 million in revenue and $125 million in adjusted EBITDA. Your stake was worth more than any number your parents would have imagined possible. Yet your daily calendar looked less like freedom than it had when you earned a salary. Marcus, now overseeing operations across multiple regions, showed you an approval report. Hundreds of decisions had waited for your response during the previous quarter. Some of these are not yours, he said. I know. Then why are they still coming to you? Because people want certainty. Marcus shook his head. They want your permission. That is different. The minority investment had been intended to remove the capital constraint. Instead, it exposed the leadership constraint. You could keep buying companies. But if every unusual decision still climbed to the same person, then the holding company was not yet a durable ownership system. It was a billion-dollar structure being balanced on one human being. Elena never asked you to sell the company. She never demanded a larger house, a public display of wealth, or access to every decision. What she wanted was a calendar she could trust. On your anniversary, she sat alone at a restaurant for 37 minutes before accepting that you were not coming. A lender had requested an unexpected meeting during a trip. You had told yourself the call would take 10 minutes. Then an acquisition issue appeared. Then a regional manager needed approval. 3 hours later, you saw the photograph Elena had sent of the empty chair across from her. She had renamed the calendar event. Anniversary, Attempt 2. When you returned home, you started explaining the financing problem. She stopped you. I understand why the meeting mattered. Then you understand why I couldn't leave. No. I understand the company had a problem. I don't understand why every problem still belongs to you. There was no accusation about money. That made the conversation harder. Sam had been a young child when you bought the first company. Now, school events, birthdays, and ordinary dinners had accumulated around the same recurring promise. After the next closing. After the next board meeting. After the next refinancing. You had built financial security for your family while making your presence impossible to schedule. Money could purchase convenience. It could pay for travel, assistance, and opportunities your parents had never been able to provide. It could not attend a dinner. It could not listen on your behalf. And it could not transform a postponed promise into time already shared. The problem existed inside the company as well. Managers had authority on paper but still watched your reactions before using it. The central team prepared recommendations designed to match what they believed you wanted. Senior employees escalated safe decisions because being overruled by the founder felt more dangerous than waiting. You had created key person risk by trying to reduce every other kind of risk. Fixing it required more than telling people to take initiative. You established written decision rights for local managers, regional presidents, the investment committee, and the executive team. Safety and compliance concerns gained a direct escalation path that could bypass commercial leadership. Marcus became COO with authority over operating decisions that had previously traveled through you. Capital limits were defined. Customer remedy thresholds were documented. Acquisition approvals were separated from daily operating authority. You also introduced calendar boundaries. Certain family commitments became no-deal windows. An actual emergency could interrupt them, but inconvenience, impatience, or a seller's preferred schedule could not. At first, you broke your own rules. You joined calls that did not require you. You rewrote recommendations after decisions had already been made. You asked for updates so frequently that the team treated them as requests for approval. Marcus confronted you again. You cannot test whether we can operate without you while standing behind us correcting every move. Delegation required accepting decisions that were responsible but different from the ones you would have made. That felt inefficient. It was also the only path toward a company that could outlive your attention. The changes did not repair your family life immediately. Elena did not trust a new calendar policy merely because it appeared in a leadership presentation. Sam did not recover missed events because you had created an executive committee. Trust returned through smaller evidence. You arrived when you said you would. You left a phone unanswered when someone else held the authority. You allowed a meeting to continue without offering the final opinion. Meanwhile, the company continued expanding. By year 20, the holding group controlled 112 operating businesses. It generated approximately $1.95 billion in revenue and $330 million in adjusted EBITDA, with about 9,600 employees. At an illustrative valuation of 13 times adjusted EBITDA, enterprise value reached approximately $4.29 billion. After subtracting $1.29 billion in net debt, estimated equity value was $3 billion. Your fully diluted 60% stake was worth approximately $1.8 billion on paper, before taxes, and without a sale. You had become the first billionaire in your family. But the more important test of delegation had not happened yet. Systems are easy to trust when results are good. You were about to discover whether yours would survive a crisis. At 6:12 on a Tuesday morning, Marcus placed a cardboard box on your desk and closed the door. Inside were copies of service tags, technician records, access logs, and inspection reports from a company the group had acquired 18 months earlier. The dates did not align. Some inspections appeared to have been recorded on days when the assigned technicians could not be confirmed at the buildings. Other files carried signatures or completion times that required immediate review. The preliminary count included 18,400 potentially affected service records. The records appeared to have been backdated. Whether the problem involved a few employees, a branch-wide practice, or a broader failure of controls had not yet been established. Marcus gave you the initial estimate. Suspending the affected work, preserving evidence, bringing in independent reviewers, contacting customers, re-inspecting sites, correcting deficiencies, and rebuilding the branch could require approximately $42 million. That was before possible claims, cancelled contracts, or consequences from lenders and regulators. On paper, your stake in the holding company was worth $1.8 billion. Inside that office, the number was useless. It could not tell you whether a safety system had failed after receiving an inaccurate inspection. It could not restore the reliability of a record. It could not explain the problem to thousands of employees who had completed their own work honestly. The board assembled that morning. Nobody argued that the issue should be ignored. The dispute concerned timing and scope. Some directors wanted a short, controlled investigation before making statements that might later prove inaccurate. They worried that premature conclusions could alarm customers, violate financing terms, or damage healthy operating companies. Those concerns were legitimate. They could also become an excuse to move too slowly. You asked one question. If we owned one of the affected buildings, what would we need to know today? The room became quieter. The company suspended the branch's affected inspection activity. Electronic and physical records were preserved. Outside counsel and an independent technical firm were engaged to establish the scope. Customers whose records could not be verified were contacted under the response plan. Re-inspections were offered without charge. Where equipment or documentation required correction, the company committed resources to address it. Lenders, insurers, and relevant authorities were handled according to the company's legal and contractual obligations. You authorized an initial $42 million remediation reserve. The reserve reduced earnings. A planned acquisition was postponed and later abandoned. The valuation assumptions in the packet were reconsidered. Executives who had spent years explaining predictable recurring revenue now had to explain why predictable revenue was valuable only when the underlying work could be trusted. For several days, your old instincts returned. You wanted every update, every customer letter, every personnel decision, every conversation with a lender. But the operating system you had spent years building was already moving. Marcus coordinated the response. The compliance team worked directly with independent reviewers. Regional presidents protected staffing and customer service at unaffected companies. The finance team revised forecasts and monitored covenant capacity. The board received verified information without forcing every decision through you. You remained accountable. You were no longer the only person capable of acting. That difference kept one branch's failure from becoming organizational paralysis. The investigation did not produce a comforting story. Early findings indicated that the suspicious records were concentrated within the acquired operation, but the holding company's integration controls had failed to detect the pattern quickly enough. The problem belonged to the group now. You could not assign responsibility to the previous owner and preserve trust by changing the logo on the explanation. Employees were removed where evidence supported action. Controls were strengthened across the platform. Inspection verification became an operating requirement, not merely a line inside an acquisition checklist. The company absorbed the financial cost. Its valuation became less certain. Some customers left. Competitors used the investigation in sales conversations. The next year's growth was lower than planned. But the company continued paying its employees, serving customers, and meeting its obligations. For 20 years, you had treated wealth as the widening distance between what you owned and what you owed. Now it meant something else. Wealth was the capacity to tell the truth, absorb the cost, and continue without transferring the entire loss to people with less power. Protecting the $1.8 billion estimate would have been easy if the number were the only thing that mattered. Protecting the ownership system required being willing to make that number smaller. That was the decision the valuation packet could never measure. Months later, the brass key returned to the conference room table. The blue fabric loop was faded. The metal was scratched from 2 decades of being carried between offices, homes, and board meetings. For years, you had treated it as proof that one decision had changed your family's financial history. Now you placed it inside a small display box with the note Alan had given you after the first closing. The door sticks when it rains. The sentence meant more now. Every company eventually encounters a door that does not open as expected. Ownership is not the ability to force every door yourself. It is the responsibility to build a system in which the right people can open it without waiting for you. You remained the controlling shareholder, but daily operating authority belonged to Marcus and the leadership team. Your role shifted toward capital allocation, board stewardship, and protecting the standards that made the company worth owning. That evening, you sent Elena a calendar invitation. Dinner. Friday. 6:30. No acquisition call attached. No promise about what would happen after the next deal. She accepted. The $1.8 billion estimate had made you the first billionaire in your family. Keeping every dollar was never the final proof. The proof was whether the company could keep its promises when protecting them became expensive, and whether you could finally keep yours when nobody was measuring the return. But ownership creates another question. What happens when a founder sells the entire company, exchanges control for cash, and discovers that liquidity does not feel like freedom? That is the next story. If you want to see it, subscribe.